Today, we're going to look back on the last 6 months of 2022, trying to make sense of what happened and how that positions the market for 2023. Hi, I'm Gordon Baker, and today we're going to talk about some good content such as interest rates, iBuyers, affordability, and prices, so stay tuned. For the last year, I've been saying that the low interest rates have kept this market motivated in spite of rising prices, because while prices are important, the monthly payment is what you have to live with, and low interest rates made these prices tolerable. When interest rates began to rise, this had a big impact. The relationship between mortgage applications and interest rates can be seen here, and specifically what happened when rates began climbing in the midst of recent price appreciation. Home buyers said, "Enough is enough. My pockets are only so deep." Remember, if the interest rate increases by 1%, the result is a 12% increase on the loan payment. So when the rates increase by 2 and 3%, this could translate into a 24 to 36% increase on the loan payment compared to payments buyers enjoyed in early 2022. The downstream effect could be seen on the sales and ultimately on prices. The median sales price for the Phoenix metro area peaked in May of 2022 at $480,000 and has been in a reactionary mode since then. A very practical way to look at this is by measuring the housing affordability, which takes into account the median family income, home prices, and mortgage interest rates. This measures the percentage of homes that were sold that the median family income can afford. A normal range is 60 to 75%. Rising home prices were already putting a strain on affordability, and this was then followed by increased interest rates, which sent the affordability to an all-time low at the end of the third quarter. 22 is an extremely low number and further shows why buyer demand was low. Essentially, the current market is struggling with affordability, especially since 74% of the buyers are owner occupants. But more on that in a little bit. I look forward to seeing what the fourth quarter number will be, since mortgage interest rates have decreased and prices adjusting downward will increase the affordability. Now, you know I was going to ask this question. Have you learned anything? If so, go ahead and hit those like and subscribe buttons, and don't forget the notification bell. This will help you be made aware of future real estate content. Now, here's an encouraging chart. Why? Because it shows who is purchasing real estate, and purchases by owner-occupants are gaining ground. Another notable change was a group that was very active and contributed to rising prices. These were the iBuyers. You may have heard of some: Opendoor, OfferPad, and Redfin Now. In the appreciating market, things were going well. iBuyers were paying top dollar for homes, but the market changed and they continued to aggressively buy properties through the second quarter of 2022 and were caught off guard when prices peaked in May. In November of last year, Redfin discontinued their iBuying program. That was after Zillow dropped their home buying business a year earlier in November 2021. Now, in August 2022, Opendoor lost money on 76% of their home sales in the Phoenix area and 42% nationally, which explains why they lost $957 million in the third quarter of 2022. It's safe to say they are now much more conservative in their offers. In fact, a couple of months ago, I contacted a major iBuyer on behalf of a client, downloading pictures and providing all the information they requested. The response was there would be no offer because there were too many active listings in the neighborhood. Just a quick note on a topic that always garners a lot of attention. As you know, I always refer to the chart showing the number of notice of trustee sales, which always precede the foreclosure itself. The low number during the pandemic can be attributed to forbearance by the lenders. The numbers now are at or below the pre-pandemic levels. Another leading indicator to watch is the percentage of loans that are 90 plus days past due, those most at risk. This chart only shows through June of 22, but it shows that Arizona is in a good position, at least at the end of June of last year. Foreclosures are not a thing right now. What about going into 2023? Arizona continues to be a state that people want to move to. In fact, Arizona was one of the top 5 states in terms of population growth, and it looks like interest rates peaked in October of last year. I received an email from a lender in mid-January that said, quote, the December Consumer Price Index report was released and showed year-over-year inflation declined from 7.1% to 6.5%. Lower inflation leads to lower mortgage rates, so rates continued their downward trend and ended the week slightly lower, close quote. That's good news. And how will the upcoming recession that is coming but not quite here yet affect rates? Downward pressure on rates. And prices adjusting downward from their peak in May only contribute to better affordability, especially for those owner-occupant buyers, the largest buying group. I know this is in stark contrast to many of the doom and gloomsters out there. This makes me reflect on something I'd heard once that may or may not apply. Often wrong, but seldom in doubt. My disbelief really kicks into high gear when anyone in the news talks about the real estate market as if the entire country is one big monolithic entity with no deviation from state to state. A good example of this is how the affordability index I mentioned can and does vary between metropolitan areas across the country. Even in Phoenix, there are differences in the market between individual cities. The bottom line is there is a constant dance between supply and demand. Right now, the number of listings has not exploded. Here you can see that they peaked last year in October and have come down but are higher than the last 3 years in January. Buyer demand is not what it used to be, but in the absence of a large number of homes for sale, current data shows that some areas of Phoenix are, yes, in a buyer's market, but others are at or leaning more towards being balanced, and a couple, believe it or not, are approaching a seller's market, but not like the crazy one we just got out of. It is highly dependent on the city or area. For the next 6 months, the dynamics of the overall Phoenix market suggest a market in correction, not a major crash like some would have you believe. Again, mortgage rates, which have been moderating buyer demand, are strong predictors of the market ahead. If you'd like more information regarding a specific city, please reach out to me at 480-326-8571. Thank you.